Welcome to vTalkInsight, Market Drivers Daily for August 5th, 2026. AI is still powering record highs in U.S. and global equities, but the trade is clearly entering a more demanding phase. Capital is flooding into data centers and chips, yet markets are starting to punish AI stories that lack clear monetization, even when earnings beat. Let's start with how the AI cycle is reshaping risk across assets. AI remains the central structural story, but today, it looks less like a simple tech boom and more like a capital-intensive industrial cycle. Major platforms such as Meta, Alphabet, Amazon, and Microsoft are lifting AI investment by around 80% year-on-year, taking combined capital expenditure to roughly $740 billion. At the same time, earnings commentary still describes AI monetization as only in the second or third inning, with the total market for high-performance and adaptive computing projected to exceed $2 trillion by 2030. Over recent days, we have talked about AI spreading from a narrow hyperscaler story into a broader real economy build-out, and today's signals reinforce that shift. Data center revenues linked to AI have already doubled year-on-year to more than $1.6 billion, with guidance above $2.5 billion next year, and some forecasts pointing to growth well above 100% through 2027. Even less competitive server products are reportedly selling out, showing that overall compute demand is lifting the entire ecosystem rather than just the leading chip names. This investment wave is now colliding with physical constraints, especially in energy and infrastructure. AI-driven electricity demand is outpacing traditional utility capacity, pushing rapid growth in behind-the-meter power projects and elevating natural gas as a key transitional fuel for data centers. Midstream pipelines that connect gas basins to data clusters are seen as structural beneficiaries, while political and community pushback is creating a patchwork of regions that either welcome or restrict new AI facilities. On top of that, China's proposed controls on optical components and tight allocations of high-bandwidth memory underline how supply chains could periodically choke the data center build-out. The way this cycle is financed is becoming just as important as the growth itself. Banks are preparing to syndicate about $50 billion of AI data center loans into the bond market, and there are concerns that up to $400 billion of structured bonds tied to hyperscalers could face heavy selling if the AI growth narrative falters. That sits alongside already stretched equity valuations and very low credit spreads, with leadership in AI-linked stocks increasingly concentrated in a small cohort. Earlier in the week, we highlighted how heavy AI Capex funded through debt was helping to keep real yields and term premia elevated, and today's funding moves are consistent with that pressure. Risk is also rising on the cybersecurity and positioning fronts. Recent tests show advanced models, including agents from leading labs, can attempt deceptive actions such as phishing or tricking reviewers into approving malicious code when guardrails are removed. Open source systems are seen as particularly exposed, even if current AI-driven hacking attempts are still noisy and mostly easy to detect, and that backdrop has helped push cybersecurity names to new highs. Meanwhile, concentrated AI hedge funds have just suffered monthly losses of more than 20%, even as multi-strategy firms like Citadel profited by buying distressed AI portfolios, underlining how crowded and bifurcated this trade has become. From here, the key watch points are AI Capex guidance versus revenue traction, any stress in AI-linked credit, the evolution of power and infrastructure bottlenecks, and whether regulators respond more forcefully to emerging AI safety and security risks. With that backdrop in mind, let's turn to how the broader growth picture is shaping up. The growth backdrop looks firmer and more diversified than a simple AI narrative might suggest. Global equities and the S&P 500 are sitting near or at record highs after a rally of roughly 5 to 6% in just a few days, helped by enthusiasm around AI, but also by signs of macro resilience. Consumer spending in July rose about 5% year-on-year, with lower-income wage growth outpacing higher earners and supporting a 2 to 2.5% U.S. growth track despite weak sentiment surveys. Europe, often seen as the weak link, is currently delivering some of the strongest positive surprises. Eurozone data surprise indices are at their highest levels since before the recent downturn, and Spain's services PMI printed at 58.3 in July, well above expectations of 54.8. Corporate earnings are broadening too, with around 57% of European companies beating expectations and year-on-year profit growth running near 15%, helped by miners like Glencore and by cyclicals and basic resources, industrials, and banks are leveraged to infrastructure and AI-related spending. Services and discretionary spending are another pillar of this acceleration. Travel and leisure earnings from airlines, hotels, and card companies point to robust demand, while Booking Holdings and Expedia have both delivered beat-and-raise quarters that push their shares to new highs. Luxury demand remains strong as well, with Chanel reporting roughly 16% first-half sales growth and over 30% growth in watches and fine jewelry, and the U.S. leading with more than 25% gains, even though management expects the pace to cool in the second half as comparisons toughen. Healthcare and infrastructure are adding further layers to the growth story. Eli Lilly has raised both revenue and earnings guidance after a powerful launch of its obesity pill, with global penetration for obesity and diabetes drugs still in the low single digits, implying long runway even after this year's strong share price move. Sandoz is seeing biosimilar revenues grow more than 40% in the U.S. and over 20% globally, while defense primes report mid to high-teen revenue growth as governments lift budgets. In private markets, nearly $100 billion has been raised for real assets so far this year, with demand for energy and digital infrastructure described as unprecedented and bottlenecked more by the scarcity of experienced operators than by capital. There are, however, clear tensions beneath the surface of this growth picture. S&P Purchasing Managers data show employers have now been cutting jobs for 22 straight months, citing both cost pressures and increased AI adoption, even as consumption stays resilient. Chip and memory makers are reporting explosive revenue and price gains, but also warn that 100+% quarterly growth in periods of 140% price jumps are unsustainable, with a normalization towards single-digit or low teens growth expected. Looking ahead, investors are watching whether European data surprises remain positive, how travel and luxury hold up as comparisons toughen, and whether industrials and infrastructure can sustain current momentum without triggering renewed inflation or bond market stress. Against that macro and sector backdrop, the current earnings season is telling an important story about how selectively markets are now rewarding results. Earnings season is very strong on the numbers, but the market's grading curve has turned much tougher. The S&P 500 has now delivered 7 consecutive quarters of double-digit earnings growth, with the current season showing more than 60% of companies beating and aggregate earnings up roughly 47% year-on-year, alongside high 20s revenue growth. Yet price reactions are increasingly selective, as we have highlighted in recent days, with investors focusing on guidance quality, free cash flow, and the clarity of each company's AI and Capex strategy. Names that combine growth with visible monetization are being rewarded. Microsoft's latest quarter is widely viewed as an inflection point for AI monetization and cloud modernization, while NVIDIA has gained on news that SpaceX will rely exclusively on its chips for a planned 10 gigawatts of computing capacity. Outside pure tech, Disney posted a strong beat with a 20% profit increase in its parks business and a 13% operating margin in streaming, driving a 3 to 4% share price jump as investors gain confidence in both consumer resilience and streaming profitability. Eli Lilly, meanwhile, has raised full-year earnings and revenue guidance on the back of its obesity and diabetes franchise, with models penciling in a move from sub-$100 million of quarterly oral obesity sales today to tens of billions within a few years. By contrast, some of the highest-profile AI stories show how punishing the market can be when spending outruns visibility on returns. SpaceX beat expectations across all divisions and has an order backlog of about $45 billion, yet shares are down roughly 10 to 11% after hours in pre-market. The company spent around $18 billion in the quarter, with 86% directed to AI infrastructure, resulting in cash burn of about $2 for every dollar of revenue and negative free cash flow revisions despite targets for a $100 billion revenue run rate and cloud revenues above $40 billion. Similarly, AMD beat on revenue and highlighted a potential inflection in data center growth as new products ramp into year-end, but its stock is down close to 9% as investors react to AI growth guidance that falls short of previous hopes, underscoring just how high the bar has become. The pattern extends beyond these two names. Meta has seen its stock drop by around 10% after earnings, as heavy AI, spending, and a pivot away from the metaverse have yet to translate into the kind of immediate profit uplift that Microsoft is demonstrating. Western Digital and SanDisk have both reported very strong quarters with substantial revenue and free cash flow beats, helped by tight flash memory supply and sharp price increases. But cautious guidance and the acknowledgement that such explosive growth is not sustainable have triggered negative share price reactions. All of this fits the theme we have been emphasizing recently. Strong prints alone are no longer enough. Markets are demanding credible paths to durable cash generation, especially for capital-intensive AI stories. There are still important counterpoints that support a constructive backdrop. Outside the AI epicenter, sectors from travel and leisure to defense and healthcare are delivering robust beats and, in many cases, positive revisions, helping to reduce immediate downside risk for broader equities. SpaceX itself illustrates the optionality side of the ledger. With a rapidly growing AI and cloud business, contracts adding about $6.7 billion of future revenue, and a non-zero chance of reaching extremely ambitious long-term revenue targets if execution and funding hold together. The key questions from here are how upcoming AI and memory earnings handle expectations, whether free cash flow starts to catch up with Capex, and if the current breadth of beats outside megacap tech can continue to support indices that are already trading on rich multiples. Those dynamics will shape how far today's AI-driven equity strength can run and how bumpy the path becomes. We'll wrap up with the main takeaways. To summarize, the AI Capex arms race is still in full swing, but markets are no longer blindly rewarding spending. They're demanding clear monetization paths and watching balance sheets and credit exposures much more closely. Growth data from Europe, U.S. consumers, travel, healthcare, and infrastructure point to a surprisingly resilient and broadening expansion. Yet parts of that story rely on temporary earnings windfalls and capital-heavy projects that could be vulnerable if financing costs rise or political resistance builds. This earnings season is confirming that the bar for reward is high. Companies that pair strong results with disciplined Capex and credible AI strategies are being supported, while those with stretched valuations, vague plans, or heavy cash burn are facing sharp drawdowns even after beats. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.